Well, we are almost at noon. Of course, my printer decides to make a noise right as we're going live, but it is now noon. So, Monday morning, this is our update. And oh my gosh, can you believe that it is August 1st? Those signs of the seasons changing are most definitely in all our local stores. I was in Costco over the weekend and all the Halloween costumes are out, the fall decor, and horror of horrors, even some holiday decorations for December. A little alarming, as I certainly feel like I am still enjoying summer or still need to enjoy a little bit more of summer. Anyway, it has been certainly a very exciting past week in the real estate mortgage world. And I am excited to share with you what is going on as much as I can, as it certainly is a little bit of a roller coaster right now. Let me get that presentation up and running. Okay, so here we go. The 1st of August, let's have a look and see what is going on. And our questions for this week, and this is based on what I'm hearing from you out there in the real world. Are interest rates going to skyrocket after the Feds increased their rates again last week? We're definitely going to delve into that into quite a bit of detail to try and understand what's going on. And the second question is, should I slash my list price? So this is sellers saying, okay, my home is on the market. We haven't gone into escrow in lightning speed time. So what should I do? Should I be slashing my prices? Okay. The aspects of the US real estate economy that we're truly going to talk about today: mortgage rates. We're going to talk about the month supply of inventory, or just inventory in general, and then home prices. And you'll see the whole conversation always ends up being around these 5 things. But a huge part of the driver for this past week has been mortgage rates. So let's jump into that national news. Okay, so love this graphic, and this comes from Realtor Magazine. And as always, my data comes right hot off the presses. Everything that basically was put out from Friday over the weekend and even this morning. And oh, by the way, just to introduce myself, I am Jennifer Tim. I am the owner of the Welcome Home Global Group. We are a real estate company, and we are powered by Keller Williams, the largest brokerage in the world. And our passion is making sure that you have all the right information so that you can make the right decision for you. Okay, so let's go into this one. And so, as I mentioned, it is totally a roller coaster. This is the nature of real estate. There's nothing unusual about that, but we certainly have some additional little twists and turns and little loops that we're dealing with on our roller coaster ride. So this article, second historic Fed rate hike unlikely to further damage mortgage borrowers. So that immediately sounds like that may be a little bit positive. And this is addressing that question of, are we going to see those interest rates just going up and up and up? And this particular article references the National Association of Realtors chief economist Lawrence Yun and a lot of his opinions. And so basically, even though the Feds did increase the Fed rate by 75 basis points, according to him, well, let's just read. So this is unlikely to do any further damage to mortgage rates, Yoon says. The long-term bond market on which mortgage rates are generally priced has mostly priced in all future actions by the Fed and may have already peaked, with the 10-year Treasury shooting up 3.5% in mid-June. The Treasury was at 2.8% following the Fed's decision. So basically, bottom line, and we haven't got that headline in here, but what we actually saw after the Feds announced this latest increase, we actually saw those interest rates come down. So there is a feeling out there in the real estate industry and in the mortgage industry that the rates have peaked. Now, I must say that these are experts, these are economists who are following the data, and they're looking at everything historically. No one has a crystal ball, but all they're doing is they're watching the trends and the trends over time. So he continues and it says, it is possible that the 30-year fixed rate mortgage may settle down at 5.5% to 6% for the remainder of the year. Still, mortgage rates are significantly higher now compared to 1 year ago, which is why home sales have been falling. And we all know that. So mortgage rates become housing's wild card, and it certainly is, because we know that that mortgage rate, it all leads into that affordability. How much can you as a borrower afford to pay on your home loan repayment every single month? We do know that the buyer demand is down because some of our buyers have been priced out of the market. So down at the bottom, now, a differing point of view, and again, this is because no one truly has the correct, clear crystal ball. It's a little cloudy. Some economists believe mortgage rates may even fall following the Fed's action on Wednesday. We saw an immediate dip. It may continue, they're saying. The Fed meeting is more likely to bring about lower mortgage rates than higher mortgage rates as long-term rates respond to growing recession worries, says Greg McBride, Bankrate's chief financial analyst. So the experts can't even agree on what's potentially going to happen. But what we are seeing currently is that kind of meteoric rise in interest rates, that very sudden jump that we saw, has slowed down and it's kind of peaked. Some believe it's peaked for the year. Others believe there may be a slight adjustment up, and others, of course, believe that it's going down. Okay, so what we do know is that because of the record high home prices, we know that because of the interest rates going up, we know that our demand is down. And according to the National Association's latest housing data, contract signings are down 20%. So that means fewer people are actually submitting offers and going into escrow. And then the sales have fallen by 14%. Now, one big factor that we always look at is these new home sales. And according to the report, it also says that they're at their lowest level since April 2020. Builders are only going to build homes that they know they can sell. So right now, the builder confidence for our new builds is waning, and that is a concern because we know that for a healthy real estate market, we need to see an increase in inventory. We're going to delve into that one a little more as we go through today's presentation. But I do like this conclusion that Yuan adds in at the end. If mortgage rates could stabilize near current levels, so now he's talking about that 5.5%-ish, 6% range, which was really where we were looking at going in 2019, towards the end of 2019. And then in 2020, we got hit with the pandemic. So he's kind of going back to that pre-pandemic where we were already looking at those interest rates, which were being raised as a measure to increase inventory, which we know we've been at historic lows. So let's go back again. If mortgage rates could stabilize near current levels, future home sales would likely then be dependent on jobs and consumer confidence, Yoon notes. Therefore, home sales could soon stabilize within a few months and then steadily turn upwards from early next year. Yoon says, NAR has updated its forecasts and is predicting home sales to fall by 13% in 2022 and start to rise in early 2023. So according to Lawrence Yoon, he really sees this as that little catalyst that we've been waiting for to get us into more of a balanced market, and we're going to slowly see that inventory increase, buyer confidence will return, interest rates are going to be manageable for those who have a need to buy, and they're going to go out and buy and sellers are going to sell, which is what we're looking for. Another couple of things that we're going to look at. So this is an article from realtor.com. And again, this came out late last week. So 4 clear signs this raging seller's market has peaked and a buyer's market may be slowly moving in. Now, I didn't include all 4 of these points. You can definitely Google this article and you can read all 4 of them. And I also want to add a caveat in here. So please remember that this data that we're looking at nationally is truly national data. It is not necessarily going to reflect what is happening in your city, your neighborhood, your street. So it's really important to realize that we're looking at the national trends, then we're going to look at Southern California, and then we're going to get a little more local, because every level, every sort of onion peel that we wrap away is going to get us closer to how this is going to impact you directly. But we have to look at that big picture because that's what's driving everything. Even though the number of homes being built has been growing after the past 10 years, it hasn't kept up with population growth, says Darren Blomquist, Senior Vice President at Realty Track. So we've talked about the interest rates. We've talked about how the interest rates have impacted the buyer demand. It's all coming back once again to the conversation about inventory. That is the number of homes that are available for purchase on the market. And we know, as we've just talked about, that we need new homes to meet the demand, and that is just not happening. So our population growth, we've got millennials, our largest buyer pool that we've ever had historically. They're now entering this home ownership market, and there just aren't enough homes to meet their needs. The pandemic didn't help, bringing in a wave of new buyers in the early days, snapping up available inventory. And then, of course, we've got supply chain issues. We've got labor shortages. So it is a concern that we don't have enough inventory to meet the demand, but the demand is there. So that reassurance from sellers is that they are still buyers, and they are buyers who are able and willing to purchase in today's market. More homes, so these are just the 2 points that I added in from today. More homes are becoming available. Again, Realtor.com June housing report shows an uptick in the number of homes for sale, and it grew by 18.7% compared with a year earlier. The biggest positive for buyers is that they're seeing more homes on the market now, says Realtor.com Chief Economist Danielle Hale. This means more options for them to consider in their home search. That's what every buyer wants to hear. They want more choices. They don't want to feel like they have to throw money at a home that they've barely been given 10 minutes to look at. And how many of us remember just a couple of months ago where if you were, as realtors, we were showing our buyers properties, there would be a line around the corner of people trying to get in to see that property, and we would be scheduled in 10 to 15 minute increments. I mean, you barely had time to walk throughout the entire home and the yard, let alone really thinking and allowing the buyers to absorb whether they could see themselves living in that home. So those days are in the rearview mirror for now, and we are very grateful for that. So what they do is they have a look at the largest metro areas. Inventory increased in 39 of the 50 largest US metros compared with last year. So they saw the most inventory growth in Austin, Texas. And as you guys may or may not know, I'm licensed in Texas and have a business running in Austin, Texas. So we're tracking those numbers as well. So we've definitely seen a slowdown there. Raleigh, North Carolina, and Phoenix. You'll note that all of these markets experiencing a booming seller's market during the pandemic. And oh my gosh, Austin was insane. And it was insane actually even before the pandemic. Price reductions. So that is going to address that second question that we've been hearing, which is, should I be slashing my price if my home is on the market? So we definitely have seen that the price reductions are on the up, which again is part of the normal season of real estate as we go into this time period where families have finished their moves, they're really settled in their new homes, getting children, if they're in school, ready for that new school year, and they don't really want to move. And then you've got some folks who just don't want to move as it gets closer to that holiday season. And as I say, those stores are surrounding us with all those signals and signs. I mean, very soon, I'm sure we're going to, those pumpkin lattes are going to be back and available for purchase. So, we know that we're there. So overall, US housing prices are still rising. Okay, so that's a really important realization that although we're not going to see as much of an increase as was predicted right at the beginning of the year because of the interest rates increases that we've seen, the median national house home price has definitely increased across the nation. Down in that very last paragraph, Realtor.com shows 14.9% of listings slashed their price that month. So that was in June, nearly double the percentage they had done so a year before. So that really means that in some major metro markets, the only way to sell your home, because inventory is increasing at such a large rate, is to truly adjust your price. Again, not reflective of every area, but is a trend that we need to watch. Talking again about that housing inventory. So this article comes from Housing Wire. They are a group primarily focused on the mortgage industry, and I like to track them. They've got an amazing economist, and I'm going to show you some highlights from his podcast that came out today. Housing inventory nationwide rises for the first time in years. So this is from a new Redfin report. So fast rising home prices and interest rates coupled with a slipping economy helped to cool the nation's housing market in June, leading to a nearly 2% increase in the number of homes on the market. That marks the first month since July 2019, pre-pandemic, that housing inventory increased year after year. Again, historical perspective, we have been in a declining inventory situation for a decade or more. So seeing that slight increase is great, but we're nowhere close to where we truly need to be to have that balanced market. Home sales decline, so we know that. They're confirming what the other economists and other articles have said. And this is probably going to continue dampening demand. Advice to sellers from the Redfin chief economist, Daryl Fairweather. I advise sellers to commit. If you decide to sell, do it quickly before demand potentially falls further. Part of that the demand decline is seasonal. And then we add in, we've got the interest rate. So be aware that if you are thinking about selling and there is a reason to sell, then now is a great time. Don't wait, because again, those crystal balls, none of us have a clear crystal balls. And I'm following anybody and everybody that I can who has a great reputation in the industry. For sellers, price carefully. This is not the time to test the waters. You'll do more harm than good if you overprice and have to do a price reduction or take the home off the market. Absolutely. Moving on. So these are just the highlights from this report. Total homes sold for the month of June came in at 524,000. So basically 15.5% year after year decline. These are national numbers, again, across the nation. Pending home sales dropped by 12.6%. New home listings are down by 4.4%. Again, builders are only going to build what they know they can sell, and they're concerned about that. So they're holding off on some of the new construction. Total homes for sale, so this is our inventory, is up 1.8% year over year. Median days on market jumped from 3 to 18 year over year as June. And now that was June, we're in August, and it's just because this national data takes a little bit of time to come out. We're only just in August. We're not going to have July's numbers for a while. So months of housing supply is up over the period from half a month to 1.7 months. Way below where we should be. The volume of homes sold above list price is still high. So 55.5% still sold above the list price. That is not, and you can tell, we are not in a buyer's market if that is the statistic that we're seeing. Now, again, it's because the market takes some time to catch up to what is happening in other areas of the economy. So Logan Matashami As I mentioned, he is an economist with Housing Wire, and I really enjoy his perspective. He's got such an amazing historical perspective on what is going on. He helps you understand how the mortgage rates are related to the 10-year yield. And again, he looks at everything from a historical point of view. So where we are currently, where their 10-year yield is and where interest rates are, he says it's basically a normal trend line that he's seeing. Now, this is his opinion. Others may have a differing opinion. And he made an interesting comment. He said, if we had 2018 pricing based on where the 10-year yield is, which then is producing the interest rates that we're at. But he said, if we were back at 2018 pricing, interest rates would be at 4.5% today. And if you think back to 2019, that's basically where we were at that point in time. COVID definitely created that unusual demand, the low interest rates that were introduced. Everybody came in, bought up all the inventory, and then the prices just shot up. So that's kind of where we are when you think about just that shorter term historical perspective. He was asked whether he thought that interest rates could drop below 5%, and he said yes. Very important point that he makes, that the new listing data for the past 3 weeks has been negative, which means, so we saw those numbers for June. He's talking about July. For the last 3 weeks in July, the number of new listings hitting the market compared to previously has gone down. That was not the intention. With the increase in the interest rates, with demand, forcing demand to kind of adjust, we should be seeing more homes hitting the market. And so the national reports that we're getting are not quite tying in yet with what the reality is in the past couple of weeks. And according to him, we have got to get to at least the 2019 inventory levels, but then understand that those levels, as we've talked about before, represented a 4-decade low in inventory. So we're still sitting with this massively inadequate number of homes available on the market to meet the demand of a growing population, our millennial pool who really believe and have confidence in home ownership. It's just not there. So he's just basically saying that we have got to get more inventory. And then the other thing that he threw in there is that nationally, the days on market, so that is the time from when you put a for sale sign in the yard and you receive and accept an offer, that those days on market actually fell. And that they didn't expect to see either. So I think the bottom line, well, this is the way that I kind of go through that is, there's the reality of what's happening with the interest rates, which, gosh, they're up, they're down, they're stable, they're down, it's a roller coaster. So making sure that you're really following somebody who's sharing the right information with you so that you can make an informed decision about when to apply for that mortgage is really important. I think the other thing is to understand that there is still a lot of volatility with what the feds are attempting to do, whether you are the school of we are in a recession or we're not in a recession. That's all going to impact the housing industry. It's a huge part of the economy. So that is it's still happening. So I think another important aspect to this, because we're talking about the price appreciation and values, we're definitely seeing that appreciation has fallen just 2 percentage points. And this is according to Black Knight, a mortgage software data and analytics firm. So I think that's important to know as well, that there is still appreciation. It's not going to be as high as we saw last year. And honestly, that was in the last 2 years, and that was not sustainable at all. And price gains are still otherwise strong because of an imbalance between supply and demand. The housing market has had a severe shortage for years. I don't know how many more times we can overemphasize supply and demand, supply and demand. It's totally what is driving everything. And all these other ways that the feds and everyone else are trying to address that may or may not be having the desired effect. And until we get to that point where we truly have we can overcome down at the bottom. The housing market has had a severe shortage for years. Strong demand during the coronavirus pandemic exacerbated it. That is what this is. Everything that we're seeing right now is because we just don't have enough homes on the market to meet the demand. How does this relate to us in Southern California? And again, after that, we're going to step down into some of the local cities that we really focus on tracking every single day. These are just some of the updates from my local lenders. Two of them were, some of them were from Friday, and I think one is from this morning that I got in. So to give you an idea of what our local lenders here in Southern California are seeing and able to offer, obviously subject to your particular situation, what you have, your credit scores. Obviously, you know, this is not a guarantee. You have to go through the application process. Now, we've just talked about that the national is about 5.5%, 30-year fixed 4.5, FHA, VA 4.25, 15-year fixed 3.75. 15-year fixed has always been great. A big one to consider is an adjustable rate mortgage, and we will be doing a I'm not sure if we're going to do it for this week's newsletter or whether we'll do it the week after next, but we're actually going to put in a little bit more of an explanation from some of our lending experts about adjustable rate mortgages, factors for you to consider. But that may be an option for you, 3.5%. So that's from United American. From Mortgage Grader, Freddie Rate Mac, the 5.3%, 15-year fixed rate, 4.58%. Applications are down, we know that. Always nice to get his little bottom line analysis here of how much more your payment might be. And then what he has been able to actually secure for some of his borrowers. 30-year FHA, 4.62%, 15-year at 4.5%. A high balance 15-year at 4.99, 30-year conventional high balance, because a lot of our loans, because of our prices here locally, are higher. So you're looking at that 5.3, 30-year purchase jumper, 5.25. And then there was someone that he was able to get in with 1 point for 4.25%. So even though the national rates are sitting at the 5.3, it may be possible to get in lower than that. And remember that these are truly those 2019 rates that we were looking at, and we thought at that point they were going to go higher. From Wells Fargo, and oh, my apologies, I didn't send this slide to the back, so I apologize to Clark for messing up my little Wells Fargo sign here. So jumbo 30-year fixed, we're looking at 4.25. I mean, they're the rates for you. I don't need to read them for you. So again, if buying is something that's on the horizon, now is a great time to have a look at what is the best product for you. So sit down with your favorite lending organization, whether it's a local bank or a mortgage originator. And if you need a referral, reach out to us. We'd be honored to refer you to some of the professionals in the area that our clients have used. So let's take that a little bit further. We're going to go through the reports on housing, just a quick summary. So this again, Stephen Thomas is a local economist that I follow, and he again has amazing historical perspective. He's been tracking the data for decades, too many D's today. And let's see what he has put down. So I think, and now again, let's put this caveat in there. Orange County is a large geographical location. We have inland areas, we have high-priced coastal communities. I mean, we've got the full gamut. So remember that this is an entire Southern California snapshot. It is not necessarily going to be what you are seeing in your neighborhood, your street, your city. We'll get down to 4 of those cities after this. The good news is we are starting to see inventory increase. Now, again, be careful when you look at these percentages, because sometimes percentages, we had a family discussion about this yesterday, because we've had so little inventory coming on, you suddenly have a few come on and then it looks like an amazing jump. It's all in the perspective of looking at the numbers before and after. But it is good to see that we now have more homes on the market across Southern California than we did a year ago. Demand is down. So interest rates, totally a function of interest rates, and also a function of where the inventory is coming on as opposed to where the demand is. So yes, the demand is down, but it hasn't gone away. Just looking a little more at that and looking at that historic perspective, 2019, which is where we really need to get to have that boring, balanced market that we're all trying to get to, and at least the 2019 levels, which again, 4-decade lows from back in 2019. So we're still got a long way to go before we get to the right number of homes on the market to truly give buyers a good option. Demand is down. And again, you can see by all of these that this is normal. Again, the 2020, this crazy dip was when COVID hit and everyone was quarantined and basically nothing could happen in real estate. We couldn't even get out the door safely. So definitely demand is down, but it's normal at this time of the year to see demand go down. Okay, so let's kind of go through this in a little more detail. Many sellers are approaching housing as if nothing has happened. Sellers don't really want to pay attention to what's happening in the market. They're still holding out for those record sales and those offers, 20 offers coming in, and the bidding war that really creates that insane over list price type situation happening. So they're stretching the asking price and testing the market as if home values are continuing to rocket higher. But unfortunately, that is leading to a lot more overpriced homes. 35% of all homes available for purchase today have reduced their asking price at least once, and that was at 19% in May. Now, again, price reductions are normal at this time of the year, but it truly is an illustration that the demand is down, buyers have more choices, and sellers have to be more realistic. It has to be closer to true market value. So I think his attention to sellers and attention to buyers is really important to read. Carefully arriving at the fair market value by scrutinizing the most recent comparable and pending sales is essential to be successful, meticulously taking into consideration the condition, location, and amenities that the home offers. It's just always the case. That is how it's your recipe for success when you're a seller. Recipe success for a buyer is, well, the market is slower than the start of the year. It is not, and that's highlighted, not a buyer's market where values are going down. List prices are coming down. There's still appreciation in value. This is not going to be, we're not entering a market where suddenly there's going to be a whole bunch of homes on the market that are an absolute steal and a bargain. It's not happening. We're not going into a buyer's market. Local news. So let's take that down into some of our local cities. And again, just that reminder, we're trying to aim for the balanced market in the middle where properties are on the market for 90 to 120 days. It's a good indication that we're in a balanced market. We have been in an insanely hot seller's market for so long, or it feels like it. So that's less than 60 days. Slight seller's market is the 60 to 90. We're not even going to look at the 120 to 150 days. So these reports are run this morning. So let's have a look at Dana Point. Dana Point, we're still seeing that we're in a slight seller's market. Now, again, keep in mind that just like when we shared earlier, when you have nothing and then you have some, and then you look at those percentages, it looks like there's been a lot of activity. it could honestly be just a few properties that are totally skewing everything. Because again, we're going to look at our coastal communities primarily, and we know the huge variance in properties that we have. You have your, anything like a $26 million property, and you might have a $500,000 condo. So all of these are going to impact the information that we see. Now, this report is single family homes only. So it's going to be that higher price point. Having a look at our market profile. So this is what's changed in Dana Point. Our median list price, 3.4 million. Median price of new listings, 1.499, so that 1.5, truly a sweet spot for the Dana Point market. Average days on market is 84, so a balanced market is 90 days currently. Based on, okay, so let's just kind of take that back, because I should have read out the median days on market, because then that eliminates our outliers. 56 days on market. We are still in a seller's market. We are not, that 84 makes it look like we're about to hit that balanced market. It just depends on the properties that are on the market and if they've been priced right for their location, for their condition, and for what they offer. So 46. Price decreased. We've definitely seen some price decreases. The price increases are always interesting, because I like to look at those and see what happened there. So we have a couple of those. Inventory, 35. We really don't have a lot of properties on the market in Dana Point. Some of our other cities do have a larger, and if you subscribe, if you receive our weekly newsletter, we actually carry those numbers in our newsletter. We do a little market update, and we show you how many properties are on the market, how many are in escrow, how many sold in the past week, average list price, you name it. We've got all that data in there for you, so that you can track week by week what's going on. If you do not receive that and you would like to, please put that in the chat, and we would love to connect you to that resource, because again, we believe in giving you up-to-date information every single week, and that comes out on a Wednesday. It's called our Welcome Home Wednesday newsletter, so that you can stay on top of what is actually happening. Laguna Beach. As we've mentioned before, this is a higher priced market. We are still in a slight buyer's market. And let's have a look. Our median price of new listings, 5.775. So that's a lot higher. So probably those properties are going to stay on the market longer. However, if we look at our median days on market, 49. So it's still a seller's market in Laguna Beach, because we have a good cross section of properties, and those that have a larger buyer pool, they're going to sell faster, because Laguna Beach is a highly desirable area. Price decrease, and we've got our price increases. So we're sitting at that 39%, so a little over that average, but we're still there, and it's still a seller's market. San Clemente is highly desirable, a strong seller's market. So if you look at the numbers, it looks like there are a lot more properties on the market, which is true that the numbers have increased, but we still do not have enough properties to meet the demand. Our median price of new listings, 1.724, and our median days on market is 42, strong seller's market. Price decreases, we've definitely seen some. So those that are sitting there longer are going to have to see a price reduction in order to attract the buyers. So we definitely have, lots going on there. San Juan Capistrano is a strong seller's market. San Juan, again, has another, all of these 4 cities that we cover in our team really, really closely, all have a huge diversity of properties available, and the demand is absolutely there. So again, think about San Juan. We've got our median list price, 2.9. Our median price of new listings is 2.395. Average days on market, let's go to our median days, 35. And we're also seeing a couple of price reductions there. But bottom line is, it's a strong seller's market, or a seller's market in our coastal areas, because we live here for a reason, and those who want to move here, and I'm working with some folks from out of state, I'm working with some other folks who are really interested and want to be in this area because they're tired of being in an environment where they are sweating for the majority of the year. It's been a tough year for many, many folks in different states in our country. And the thought of living at the coast and enjoying the coastal breezes, I mean, I've got the window wide open, the breeze is coming off the ocean, and it's just so pleasant. Not an air conditioner in our house. So back to our questions, our bottom line. Are interest rates going to skyrocket after the Fed's increased rates again last week? And should I slash my list price? And we're going to go back to this slide. And to address the first one, I think we've answered that it really depends on what happens to that 10-year yield and that trend line. We saw the interest rates coming down. So are we going to see a meteoric skyrocketing interest rate? Not according to all the experts out there. And remember that the Fed rate does not directly it is not the interest rate, the mortgage interest rate. The mortgage rate really is associated with what happens in the market. So when the Feds raise that interest rate, the Fed rate, it's not an automatic increase for mortgage rates. So, when you hear that headline, stop and look for the information to see how the mortgage market is responding to that. So we know that we've got some people saying it's going to maybe go up to 6%. We've got others who say it's going to drop, and others who say probably going to go under the national average of 5%. And what do we see locally? A lot of those rates are under 5% already. Buyers are returning. Their confidence in our local cities is absolutely returning. And all my lenders are telling me that those buyers that held off, so they were interested at the beginning of the year, they got pre-approved, then all the storm happened with rates and, what's happening, and buyer confidence basically dropped. They're all back. They're all back and buying with a vengeance. Sellers, most important thing about how you're pricing your properties, it has to be fair market value. So we use a term in our team, it's called pricing ahead of the market, where we're going to look at everything currently, and then we're going to look at when you're going to put your product on the market, and we're going to make sure that that price is going to be the optimum price so that you can achieve your goals. But you have to be realistic, and it's today's market, not where we were a couple of months ago, and definitely not where we were a year ago. So sellers, you may have to slash your price if you've been sitting on the market and you have not received offers and you've got no showings. Basically, the buyer's market has rejected your product, which means the price of your home. So going back, and you've got to look at all those important factors. Buyers, those interest rates, yes, make sure that you're paying attention to that, and we're not going into a buyer's market. We're just not there. It's not going to happen. Our goal, if we can get to a balanced market, is the best we can really hope to achieve. So here's our summary again. We're going to go through it really quickly because it all still applies. Sellers, price ahead of the market, condition, location equals the price. Days on market, you want to avoid that as much as possible, because the longer the days on market, the more you're going to have to do price reductions. And boy, is that the biggest go for buyers who are going to say, oh, well, they're going to be open to serious negotiation. And most of the time they're right. They're going to come in with greater demands for you, Mr. and Mrs. Seller, if you have not priced your home correctly to start with. It is never a good idea to go way up and over with the expectation that the buyers are going to meet you where you are if you are above the fair market value, when they've got more choices. Not as many as they'd hoped for, but there's still more choices on the market than there were a year ago. Staging is really important. You're going to make your home look like an HGTV renovated home. Although we know that very few of our homes are like that, but it's so important. And we know that our demand is down and the inventory is going to rise, but it's still not going to be where we need it to be. Buyers, budget. You've got to know your budget, get your financial ducks in a row, make sure you know exactly what you can afford, whether you've got extra money, whether you're going to take advantage of a financial gift from a family member, and what your lender's going to allow. follow the market, understand what's happening in the neighborhood, the street that you want to be in, the city, and then have a strategy. And it all boils down to hire a real estate consultant, whether it's someone else. We're here to just give you the information that you need. Obviously, my team would be honored to sit down with you, whether you're a seller or a buyer, and help you get the information that you need to make the right decision. And here's our contact info. If you have any questions about what we've covered today, please don't hesitate to reach out. This is what we are absolutely passionate. We can't force anybody to buy or sell a property, but what we can do is make sure that you're empowered with the right information so that this whole process is the least stressful we can possibly make it. That's what we are here to do. So welcome to August. Once again, the future is rosy, and don't rush into that holiday season too quickly. There's still an amazing amount of time to be spent enjoying the summer and where we are and our real estate market today. Have a great day.